Here's a number that should get your attention. A pensioner couple with $450,000 in assessable assets is receiving a reduced age pension right now, and they have no idea why. They've done everything they were told. They saved. They were careful. They don't feel wealthy. But Centrelink is quietly reducing their fortnightly payment, dollar by dollar, and the reason isn't what they think it is. If you're on the age pension or you're about to apply and you haven't sat down and really understood how the assets test works, this video is for you. G'day, I'm Paul, and I want to say this up front. If the assets test has been stressing you out, that's completely normal. It's one of the most misunderstood parts of the whole pension system. But by the end of this video, the confusion is going to be gone. I'm going to walk you through exactly how the test works, where most people go wrong, and what you can actually do about it. No jargon, no panic, just a clear picture and a practical plan. Now, before we get into the numbers, let me explain what the assets test is actually doing, because most people have a fuzzy idea at best. The assets test is one of two tests Centrelink uses to work out how much age pension you're entitled to. The other is the income test. Centrelink runs both, and whichever one produces the lower pension payment is the one that applies to you, so you don't get to choose. The test that hurts more is the one that counts. The assets test itself is straightforward in principle. Centrelink adds up the value of what you own, compares it to a threshold, and if you're over that threshold, it starts reducing your pension. If you're well over it, it cuts out entirely. Simple enough on the surface. But here's where people go wrong, and I see this all the time. They treat the assets test like a cliff edge. They assume that if you're over the threshold, you lose everything at once. You don't. That's not how it works, but we'll come to exactly how it does work in just a moment, because that mechanism is the thing most people miss completely. The other big mix-up I hear is people confusing the assets test with deeming. Deeming is part of the income test. It's the rule where Centrelink assumes your financial assets are earning a certain rate of return, whether they actually are or not, and counts that assumed income against you. That's a separate beast. The assets test doesn't care what your money is earning. It cares what your money is worth. Two different tests, two different calculations, and mixing them up means you're solving the wrong problem. So when Centrelink says assets, what are they actually counting? This is where it's worth slowing down. They're looking at things like your savings and bank accounts, shares and managed funds, investment properties, caravans, boats, and most personal possessions above a certain value. They are not counting your primary home if you own and live in it. That is excluded. But everything else, superannuation once you've reached pension age, your partner's assets, if you have one, the lot, goes into the pile. And here's the part that catches people off guard. It's not just about whether an asset exists, it's about how Centrelink values it. A managed fund, a term deposit, a rental property, they're not all assessed the same way. Some assets are assessed at their current market value. Some have special rules around how they're counted, and if you've recently sold something and the cash is sitting in your account, that cash is absolutely accessible, even if it feels temporary. Now here's the curiosity re-hook I promised you. The part most people miss is not the headline threshold number. It's what happens just above it. Because the assets test doesn't work like an on-off switch. It works like a sliding scale. For every 1,000 your assets go over the lower threshold, your fortnightly pension reduces by 3. That's $78 a year, per $1,000. And it keeps sliding quietly the further over you go. You could be sitting 50,000 over the lower threshold and losing 3,900 a year without ever receiving a single letter telling you that. The pension just comes in a little lower each fortnight, And if you've never done the maths, you might not even notice. That's the trap. Not the cliff edge people imagine, but a slow, steady reduction that compounds over years if you're not watching it. And the fix, once you understand it, is often much more manageable than people fear. There's one more misconception worth naming here. Some people I talk to assume that as long as their total assets are under some round number they heard somewhere, they're fine. The actual thresholds depend on whether you own your home, whether you're single or in a couple, and they're indexed and updated regularly, so the number someone told you 2 years ago might not be right today. I'm going to use the current figures as a guide in a moment, but please, always check with Centrelink directly, or talk to a licensed financial advisor, because this is general information, and your situation is going to have its own detail that matters, right? So you now know the assets test is a sliding scale, not a cliff. You know it's separate from deeming. You know what counts and roughly what doesn't. And you know that the quiet reduction per $1,000 is the mechanism most people are completely unaware of. What comes next is where it gets genuinely useful. I'm going to walk you through the 3 numbers that actually determine where you land, run a real worked example, and give you a clear framework for what to do if you think you might be affected. Stick with me. The hard part is already done. Let's make this real, because nothing cuts through confusion faster than a worked example with actual numbers. So let me introduce you to Margaret. Margaret is 68, single, and she owns her home outright. She's got $280,000 in a savings account, $95,000 in shares, and a car worth $15,000. Her total assessable assets sit at $390,000. Now, the current lower assets test threshold for a single homeowner is around $314,000. That's the point where the full age pension starts to reduce. Margaret is $76,000 over that threshold. Here's where most people get it wrong. Margaret's friends told her she'd lose her pension entirely once she went over the limit. She's been quietly dreading this for years. But that's not what happens. Remember the sliding scale. For every $1,000 over the lower threshold, the fortnightly pension reduces by 3. So let's do the maths. Margaret is $76,000 over the threshold. That's 76 lots of 1,000. 76 multiplied by 3 is 228 per fortnight. So Margaret doesn't lose her pension. She receives the maximum single-age pension, currently around $1,144 per fortnight as a guide, minus 228. She's getting roughly $916 per fortnight. That's still meaningful income. And she's getting it because she's under the upper cut-off threshold, which for a single homeowner sits at around $686,000. Below that, you're still in the system. You're just on a reduced rate. Now here's the turning point I want you to sit with for a moment. If Margaret sold those shares tomorrow and the $95,000 landed in her bank account, her total assessed assets wouldn't change. The cash is still accessible. The number stays the same. But if instead she paid off some urgent home maintenance, legitimate expenditure on her primary residence, that money is spent, no longer an asset, and her assessed total drops. Same money, different outcome. That's why the assessed value is what matters, not the raw dollar figure you see on a bank statement. And here's the subtler version of that turning point. If Margaret's assets increased by just $10,000, say a maturing term deposit rolls over with interest, her fortnightly reduction doesn't jump off a cliff. It increases by another $30 a fortnight, $90 more per month. Not catastrophic, but not nothing either, especially compounded over a year. That's $780 she didn't have to lose if she'd understood the mechanics earlier. That's the practical takeaway from Margaret's story. The assets test isn't a monster waiting to swallow your pension whole. It's a precise, mechanical calculation, Assessed value minus threshold, divided into thousands, multiplied by 3. That's the fortnightly reduction. Once you see it that way, the fear goes away, and the question becomes a planning question, not a panic question. So let me give you the framework I promised. 3 numbers that matter for every Australian pensioner. Number 1 is what you own in assessed terms, not what you feel like you have, not your general net worth, but specifically what Centrelink counts. Financial assets, investment properties, vehicles above a modest value, super once your pension age. Your home, if you live in it, is excluded. Write down the list. Put a dollar value next to each item. That total is your starting number. Number 2 is where your payment starts to change. That's the lower threshold for your situation. Single or couple, homeowner or non-homeowner. Those 4 combinations produce 4 different thresholds, and they're updated regularly. Don't rely on a number someone told you at a barbecue. Check the current figure on the Services Australia website, or call Centrelink directly, or ask a licensed financial advisor who knows your circumstances. This is general information, and the specific numbers that apply to you need to be confirmed with someone who can see your full picture. Number 3 is the reduction rate. $3 per fortnight for every $1,000 over the lower threshold. That's the lever. Once you know how far over you are, you can calculate your own reduction in about 30 seconds. And once you can calculate it, you can plan around it. Those 3 numbers are all you need to go from confused to clear. Now, the biggest misunderstanding I want you to walk away with is this. Most people think the assets test is about whether you have too much. It isn't. It's about precisely how much your payment reduces based on assessed value. That's a completely different question. One creates fear. The other creates a maths problem you can actually solve. The simplest thing you can do this week is grab a piece of paper and list everything you own that isn't your primary home. Put a current value next to each item. Add it up. Then go to the Services Australia website and look up the current lower threshold for your situation. Compare the 2 numbers. If you're under, you're fine for now. If you're over, take the difference, apply the $3 rule, and you'll know exactly what it means for your fortnightly payment. That's it. 20 minutes and a clear picture instead of years of vague dread. One more thing before I let you go. Everything I've walked you through today is general information. It's a guide to how the system works, not personal financial advice for your individual situation. Your super balance, your partner's assets, recent transactions, all of it can shift the numbers in ways that matter. So please, check with Centrelink directly or sit down with a licensed financial advisor who can look at your actual position. The principles are the same. The details are yours. If this helped, do me a favour and hit subscribe. I put out a video every week helping Australians in and around retirement cut through exactly this kind of complexity. And if you've got a question or Margaret's story sounds a bit familiar, drop it in the comments. I read everyone. I'll see you in the next one.